Are there any other questions?
One from Lindsay. She says she doesn't have much experience working with CDFIs, but she knows in small rural areas not many people have credit. Is non-traditional credit ever considered for the loans you mentioned?
Yes, absolutely. Non-traditional credit is, and in fact, we have a slide on non-traditional credit, and that's coming up in one of our next sections. Okay, any other questions? Okay, next slide, please. So I'm just going to pose this question, and you can put this in the chat, but I'm kind of interested in are there any different types of lending your organization is currently doing that I didn't mention today?
Hi, Flo. This is Tawny. Just wanted to interject on that. You did cover it, the community development, but with Indian Collective, we're focusing on large scale capital lending for tribes and tribal nations. So it's definitely within this wheelhouse, but like right now we're working on closing a $1.5 million eel aquaculture project. So I just wanted to kind of talk about just a little bit larger projects, which it really just adds to the complexity and intricacy of really underwriting and doing that due diligence.
Yeah, absolutely. I bet you that's an interesting project. That's like, I love like kind of aquaculture and different things like that. So I would kind of be interested in the ins and outs of that. And I have somebody that wrote in chat that they're doing second mortgages and down payment insurance, down payment assistance, employee loans, tribal loans, mortgage foreclosure prevention, business, agriculture, burial loans. That's one that I haven't seen much of. So that's great. Okay, next slide, please. And I'm going to go ahead and turn this over to Alex now, and she's going to be the next presenter.
All right, everyone. So next we're going to dive into our loan officer responsibilities. So we're talking about this because the loan officer and the work they do is often intrinsically involved in the underwriting process. Even more so, the loan officer will typically partially or fully underwrite the loan. Next slide, please. So in this section, we'll be discussing the general loan officer responsibilities just throughout the underwriting process, along with some best practices and strategies to use. So overall, we'll be covering initial client intake, application and document collection, credit history, financial analysis and due diligence, loan negotiations, assessing training and technical assistance needs, and then again, best practices. And we'll also mention a few client barriers that you might run into and some management strategies to overcome those barriers. Next slide. Okay, so we're going to start with the initial client intake. So sometimes you'll have a returning loan client or someone you've already worked with, but you still need to ensure you follow the same intake process as you would with a brand new loan client. So it's important because you need to have a consistent process and make sure that everyone has the same experience and that you don't really miss anything by having different processes happening. So the initial steps you'll take during the intake phase is first you'll identify your client's needs and their initial eligibility. So this just comes from discussion with the loan client, and it helps establish the basic information you need to begin the process. You know, what do they need the loan for? What are their financial goals? Do any of the loan products you have immediately meet all of their needs and goals? Are there anything that you can automatically see they're not eligible for? And then do you have any red flags that you notice right away? Kind of to go along with that, as you're having those discussions, you'll also be able to determine your client's loan readiness. And that just means, is your client ready to take on a loan? You know, do they understand their financials and the responsibility of taking on the debt. Do they need some sort of courses or training before you feel that they're loan ready? You'll want to do this before you get too far in the loan process, especially if you immediately identify anything. Because if they're not ready, you'll want to provide assistance as soon as you can or discuss plans with them so they can become loan ready. You know, you don't want your loan client spending too much time applying for the loan when you know they're not quite ready and they have a few steps that they need to do before they get to that point. Next, you need to make sure you explain each of your loan products thoroughly. And when you're explaining that, you'll need to explain how it would work for the loan client. So kind of direct it towards them to see how it best fits. You can point them to a product that would be the best fit for them, but sometimes there are multiple options that could work for the loan client. So just going through, asking the right questions and discussing what the loan client wants is really important. And you also need to take into consideration with that their eligibility requirements, because there might be a loan that fits perfectly for them, but they might not be eligible. So that's just something to look out for. And just through those discussions, you can kind of come to a decision to see what sort of loan products you want to move forward with and make sure the loan client fully understands what that loan product is and what it'll actually do for them. Next, you'll need to explain your loan process. Basically, what will this journey with you look like for your loan client? You know, what will you be asking for and why will you be asking for it? What will be required of them to complete? And then it's also helpful to give them an order and a general time frame of the various steps in your process. So how long does the application take? What does the underwriting look like? How are you going to go about getting their loan approved? Things like that, just so that it makes the client fully aware. And it really makes them feel well prepared entering into the loan process and avoids confusion. Because if you have that, it can really lead to frustration for the loan client and yourself and a lack of trust from both sides. So just being very clear and honest with what this will look like will help your relationship and help the loan go more smoothly. So kind of to go along with that, you also need to make sure you set reasonable expectations. So you don't want to overpromise or guarantee anything. This could include like unrealistic timeframes. If you know your organization is super busy, you know, you won't be able to get their loan approved in a week. So don't tell them that you can get their loan approved in a week, that sort of thing. And because if you're unable to meet these promises, it really harms the client relationships and causes a lack of trust because you can't, you know, meet the things you've said you'd meet. It's really best for the loan client and your organization to be as realistic as you can and be as honest as you can on timeframes, eligibility, funding, loan amounts, that sort of thing. It might not be what the loan client wants to hear, but honesty is always the best option to help a good relationship continue. Next, it's helpful to provide a list of needed documents with the explanations of why you need those documents. So sometimes you'll be asking for things and loan clients will be like, why are you asking for that? Why do you need that? So just a short explanation to explain your process and explain why you need it can really put the loan client at ease and make it easier for you to actually get that documentation. We recommend that you have a standard checklist or standard document already prepared that you can give to all of your loan clients. You know, you will be able to discuss it with the loan clients, but it's good to have some material that they can take away and have and look at because, you know, people always have questions and having a resource for them to refer to is really the best options. All right, and then next, sometimes a loan client will complete their application before you have this initial client intake, but if not, you'll need to direct them to the loan application. This can either be online or in person. You know, if your organization is having in-person meetings right now at all, sometimes you're even able to have them complete the application while you're talking with them so that you can make sure Everything you need is in there, and it makes the process easier for them. So it's important to always get a loan application, even if you have some elements that you can start your underwriting and due diligence process with. You always want to make sure you have that completed. This allows, again, for a consistent process and also appropriate documentation for your loan. And finally, you'll need to make sure to leave with a commitment to follow up and get a time frame commitment from the loan client. So if they have any items that they need to complete, such as completing the application online or sending you documents that you've requested, try to get an estimated completion date from them, some sort of commitment to kind of keep them on track and give them somewhat of a deadline just in their heads. It's not a firm deadline, but it really helps move the process along. And then it allows you to follow up accordingly. All right, next slide, please. So next we're going to the application and document collection. You know, in general, the application process and document collection happens as it's shown on the slide. So first you'll get that loan application before or after your initial client intake. You'll review the documents that they send you. You'll review the application for completeness and then talk to them. And sometimes that'll give you more details about what specific documents you may need. If you have any, you know, special documents or out of the norm documents you may need. And then you get those documents and review them as you get them in. Make sure that when you get them in, you are reviewing them and that they are sending you the correct items. Because typically it's best if you notice that something is wrong to get that right away. Because it's easier for the loan client and you're not coming back to them much later in the process asking for something they submitted a while ago. And then as you're reviewing your documents and having discussions with the loan client, you may come across some more information or signs that they may need some sort of training or course requirements completed. When you identify this, make sure just to discuss it with the loan client as soon as possible so that you can avoid delays on their loan. The delays can be frustrating and discouraging, so anything to mitigate that would really helps ensure a smooth and positive process for the loan client. Also, during your review and conversations, you may identify red flags or potential problems. In regards to documents, this could be red flags on their credit report, in their financial statements, or any other documents they provide. It's best to address these concerns as soon as you notice them, and that'll allow the best opportunity for you to either mitigate those red flags or find a solution to get around them or correct anything that the borrower is able to correct. So also throughout this, you need to have consistent follow-up and communication. This is just one of the most important things for a loan officer. Because it really helps the loan client through the process and makes completing everything easier for you, easier for the loan client, and causes less stress overall. So that's just the general flow of everything, but some steps, you know, can happen simultaneously, or the order may switch around depending on your conversations and the way you're meeting with the loan client. So, you know, applications don't happen in a single step. Your procedures in collecting loan applications will be part of your formal loan policies, you know, but the actual process will feel and develop more organically as you have interactions with the loan client. So it's important just to be flexible and don't get overwhelmed. You know, the most important thing is to hit all of these steps at some point and get everything that you need to close the loan. Next slide, please. So next, we'll be covering credit history, financial analysis, and due diligence. This is just the general responsibilities a loan officer has with those items. We won't go into super detail about everything you do with that, but just have a overall look at it. So First, we'll be looking at credit history. So that's when you pull their credit report and review it. This is really helpful because you can immediately identify any red flags or problems. This could be, low credit score, late payments, or even things like bankruptcies or foreclosures. So it's really important to do that earlier in the process so you can get that information right away. Then next, after you receive all your documentation and everything you need, you'll be able to complete your financial analysis. This is where you review the financial statements that they provide you, determine their financial ratios from that, and basically determine their ability to repay your loan. So you get a picture of the financial health of the borrower and whether it fits with the requirements you need to get their loan approved. And then finally, you need to ensure all due diligence items are completed in order to have an approvable loan. So these due diligence items can happen prior to approval or after approval. It kind of depends. So prior to approval would be something like evaluating collateral, getting your appraisals, having necessary insurance in place, and reviewing any titles you may need. And then after approval or even at loan closing, this would include like perfecting your liens, holding title, and ensuring everything is filed and recorded correctly to make sure all your loan requirements is covered. Great, next slide, please. So loan negotiations. This happens after you submit everything to your approval authority, so your executive director or your committee, anything like that, and you get your loan approved. So after it's approved, you'll be able to finalize everything with the loan client prior to closing. This includes the loan amount, interest rates, term, any prior to close conditions that your credit committee asks for, and any loan covenants that your loan client will need to fulfill after closing. It's important to ensure your loan client understands everything about the loan. Importantly, like what they will be paying, when they will be making payments, and what covenants they will be expected to adhere to. No detail is too small. This may be the loan client's first loan, so don't assume they would know what this is. Discuss it with every loan client, and that'll help maximize the chances of repayment and really have a successful loan. To go along with that, it's really a good idea to review the proposed payment and payment schedule to confirm that the borrower is aware and ready to add this additional payment to their monthly expenses. You know that they can do it because you got the loan approved, but you have to make sure they're aware and fully prepared to do that. You really don't want anything to be a surprise or blindside the loan client down the road. This just really helps create a better relationship and more trust with you and results in better repayment. Next slide, please. Okay, so training and technical assistance needs. We've kind of discussed this throughout the other slides briefly. But throughout your loan process, you'll be able to identify areas that loan clients may need training or additional assistance before they can get a loan. Sometimes these trainings and courses will actually be a requirement for a specific loan type you have. So if they're getting a business loan, they might have to take, a business ready course or take a course to show how to develop a business plan, things like that. But other times you'll identify these needs through conversations and asking the right questions. With this, you just need to make sure to pay attention to everything your loan client is saying and, how they're acting or feeling about the loan. And just keep an eye out for opportunities to help them, because that's what we're here for. We're here to help them meet their financial goals. And this will just ensure they are able to succeed and, be able to repay the loan appropriately and really feel better about meeting their financial goals. Next slide. Okay, so just a few best practices to go along with everything we've discussed. For one thing, only request the documents you don't already have. You know, if you already have information on a client from a prior loan or a training relationship, try to get them to verify those documents instead of resending them to you. The fewer documents you have to collect from the loan client, the easier the process will seem. And it also just makes it easier and faster for you to underwrite their loan. To go along with that, it's important to provide resources to help them in gathering their documentation. Some clients might not know off the top of their heads when they completed a certain course or what their employer's phone number is, things like that. And just provide resources or direct assistance to help them quickly access this information. Next, avoid over documentation. Just everything you collect should be for the loan, and you want to have a reason for why you're collecting it. You don't just want to collect it because everyone else is collecting it or you've always asked for that, things like that. Just make sure you actually need what you're asking for. Again, communicate with your applicants regularly and consistently. And then to go together, make sure you and your staff are staying organized. And along with that, ensure everyone is on the same page. You don't want to have to ask for the same form again, you know, because it got misfiled or misplaced. Borrowers rely on you to keep their personal information confidential. And, you know, an organization that doesn't misplaces their information doesn't feel safe. Next slide, please. Okay, so now we have a few clear client barriers and management strategies. The first one is process confusion. You know, getting a loan can be confusing and it can be the first time the loan client has ever gotten a loan before. You know, what we do every day may seem obvious to us, but it could be a whole new thing for them. So nothing is too simple to explain or go over, and just make sure the loan client knows everything. Next is the lack of documentation or financial statements. Some people don't have these documents or they don't know how to get them. So always be prepared to walk them through acquiring these documents, and make sure to be flexible and find creative solutions. Next barrier would be undefined or unsure goals. You know, some borrowers don't know what they want, or they have conflicting things to what they want. So make sure to have thorough discussions and provide options and scenarios and explain how it will impact them. You know, allow them to make an informed decision, but provide your expert advice. And then the final one is a sense of not belonging. You know, getting a loan can be scary and intimidating. And again, this might be the loan client's first time in this situation. So just make sure to be approachable with your process and language. You don't want to make anything too complex or intimidating. And really focus on education. You never know the level of knowledge or experience your loan client is coming in with. So no detail is too silly, and don't assume that they know something you haven't told them. So again, it's all about relationship building, not just loan origination and processing. Okay, next slide, please. All right, do we have any questions about everything we covered? We could either have them in the chat or you can unmute for a second. Okay, so I think we're good. We can go to the next slide. And we're going to have a quick 5-minute break now. So I have 11:42 Mountain Time. So we'll see you all back here at 11:47.
Okay, once everyone's back, we do have a couple questions in the chat for Alex, Will, and Jamie, whoever wants to answer. First, we have from Janelle about forms and data. They use Otis, and sometimes they have issues with clients being burdened with forms. Are there any tips on making this easier?
Yeah, so I'll go ahead and answer this. I did message Jonelle privately. We also had somebody else ask about the forms. For those of you who are already on Otis, there is a way that we can simplify that form processing, and that's with another software application called LenderFit. So if you'd like to get more information on that, you can contact us after this webinar, and we can send you additional information on that. And that is a system that basically does your client intake kind of for you electronically, and all the forms and the data from your clients are stored there, and you don't have to keep separate paper files or anything. So it's kind of a really slick system. And OWISTA is in the process of converting over to LenderFit currently for all of our lending applications. We also had another question from Lindsay. Is it appropriate to suggest which lender to go with when a client asks? If you feel comfortable, I mean, you should, it's always got to be kind of up to the client to choose like whether they're going to obtain a loan from you or not, or go to like the next, banking institution. I would definitely caution against going through the whole underwriting though before you address that, because every time that client's credit is pulled, so if they come to you with a credit application and then go to 3 other banks for a credit application and they are working on all those applications at once, each time each institution is going to pull that client's credit, and that's going to cause their credit score to decline because they've had so much activity on it. So I would definitely make sure that the client understands what they're applying for and that they want to obtain a loan from you before you continue on with the due diligence and the underwriting process. Does that help answer your question?
Hello, can you hear me?
Yes.
Yeah, it does. I'm actually not like a loan processor. Our business doesn't provide loans. I provide assistance with education and guidance, helping the community members prepare for home ownership. So there's many different lenders that I could refer them to, but I do tell them exactly what you mentioned, that their credit will be pulled each time. And I help them kind of do the research before they select, so they can make an educated decision on who they want to go with. But I just wanted to clarify that with you all. Thank you.
Yeah, so you're doing homebuyer education, and there are rules that you have to follow for that. You, as a counselor and an educator, you are not allowed to tell them which loan to get. So in your case, all you can do is present them with all of their different options. So all the different loan types, the 502s, the 184s, conventional, FHA, all of those different types of loan products, and explain what the terms are and what the down payment requirements are. They also have income guidelines that go with each one of those different loan types. So yeah, that's all you can do as a counselor, is just explain what their options are and let them make that decision. Okay, any other questions? And then to answer, we are recording this session, and I know some people who have logged in late because we now have 56 participants, and so some of you have missed a portion of this. We are recording this, and we will get the recording from Native Learning Center, and we will send it out to all of the participants after this webinar. And can we go to the next slide, please? So I'm going to talk about the 5 C's that we use for credit analysis next. And then go ahead and go to the next slide. So the 5 C's are characteristics of credit. They're character, capacity, capital, conditions, and collateral. They're the framework that many lenders use to evaluate potential borrowers' creditworthiness. Next slide. The first one we're going to talk about is character, and this is AKA credit, so it's also known as credit. But character is the most comprehensive aspect of the evaluation of creditworthiness. The applicant's credit or character speaks to their overall trustworthiness as a borrower. And some of the questions that we'll answer is, can the borrower be reasonably expected to repay this loan? Will they make their payments on time every month, month after month, until the loan is paid in full? The borrower's credit score and credit history both play big roles in the character aspect. As a loan officer, you want to see a long history of using credit, whether that be credit cards or auto loans or housing loans, different things like that. You want to see consistent on-time payments across all of their accounts that are appearing on their credit report. And you want to make sure that all of their current credit accounts are currently in good standing and not overdue or in collections. Next slide, please. How do you determine credit? How do you determine character? The first thing you're going to do is credit report. You're also going to review, and this is something one of our participants brought up earlier, and that's non-traditional credit history. So it could be that many of your clients, if you're serving a Native community or in a rural community, they may not have much credit. They might not have any credit at all, or the credit that they do have is bad. So then you're going to move on and look at those non-traditional credit history references. You're also going to review their work references, their work history, their complete loan application, and just basically anything you can use to find out about this person. And next slide, please. And so this is the slide I was referring to earlier when somebody asked the question about non-traditional credit references. So you would use this when there's little or no credit on the report, or if the credit is bad. So some of the things you can look into, copies of their bank statements, so you can kind of see their cash coming in and out and how they're meeting their obligations every month. Do they have any cash left over, or is their bank account at zero at the end of every month? Or like just $10 left, and that kind of gives you an idea about if this person can really handle this loan. You also can request utility statements from them and review those to make sure those are paid timely. You can ask for a landlord reference, and then some people might have unsecured lender references. So it could be that they have a loan with somebody else privately that isn't showing up on their credit report, and so you could get a reference from them. It could even be a family member. And then you also could reach out to their child care providers. You could ask for cell phone bank statements, and there's a whole array of other non-traditional credit references. But yes, you definitely can use non-traditional credit references for judging any of the 5 C's. And next slide, please. So the next C is capital, or AKA commitment. Capital represents the overall pool of assets under the name of the borrower. It represents one's investments, savings, and assets such as land, jewelry, etc. Loans are primarily repaid using overall household income. So capital is kind of an additional security in case of unforeseen circumstances or setbacks such as unemployment. So this is always something that you want to review when you're doing your due diligence. And next slide, please.
We do have one question. What if the tribal member has a lot of overdrafts? Can that hurt being qualified for a loan?
It absolutely can, but you don't want to base your decision just on that fact that they have overdrafts. You're going to want to go through these 5 C's and their credit history, their employment history, their standing in the community, how people view them, different things like that. You're also going to want to look at those non-traditional, credit references, because you don't want to base it solely on overdrafts. You want to make sure that the decision you make as an underwriter or as a loan officer is based on a whole array, so that you're getting the total picture of the ability of this client to repay the loan that they're requesting. So the next C we're going to talk about is conditions. Conditions refer to the specifics of any credit transaction, such as principal, amount of rent, such as the principal or the amount or interest rate. Lenders assess risk based on how the borrower plans to use the money and should they receive it. Other external features such as the state of the economy, prevailing interest rates, pending legislation, and political change are also considered. The features are not individualistic as they cannot be influenced by the borrower. Nevertheless, they indicate the level of risk associated with a certain loan. For example, during a major recession, even borrowers with a 700 plus credit score may not be able to access credit. Next slide, please. Conditions. So conditions are, there's external and internal conditions. So external would be something kind of like what we're facing now with the COVID pandemic. It could also be natural disasters like a major tornado or a hurricane. It also could be economic related with a high unemployment rate. Internally, it could be a whole array of things that were going on internally with the person, like other responsibilities such as college-bound children or a terminally ill family member. Those you can factor into and evaluate the conditions, and because this may affect the future payment obligations of the borrower. So if you know some of these things that are already going on, you definitely want to consider them when you're doing your due diligence. Next slide, please. So the next the next C is capacity, or AKA cash flow. A borrower's capacity to repay the loan is a necessary factor for determining the risk exposure for the lender. Capacity is also often referred to as cash flow, and it's the barometer for how well a loan applicant can manage their future loan payments should you extend them credit. The applicant's income amount, history of employment, and current job stability indicate the ability to repay outstanding debt. A borrower's debt-to-income ratio, which is the ratio of the borrower's current debt to current income before taxation, both currently and after the new loan, may also play a role in determining an applicant's capacity. It is important to note that collateral is not considered a fair metric for qualifying the applicant's capacity, because it is only liquidated when the borrower fails to repay the principal amount of the loan. Also, in some instances, there's no collateral at all because the loan is unsecured, such as a credit card loan. And next question, please. So some of the things that you're going to want to ask yourself as an underwriter or a loan officer when you're viewing capacity for a loan client: how much cash does the applicant need to cover their household expenses? Do they have enough cash to make loan payments with a cushion left over? And are there any other sources that are supporting the family, such as a second income by a spouse, a second job, perhaps per cap, different things like that. So when you're during the due diligence, you're definitely going to want to ask those questions of yourself and try to like kind of figure those notes so that when you're determining that cash flow for that applicant, that you are readily able to answer, yes, even with this new loan payment, they're going to have money left over if an emergency comes up, or I have accounted for like gas for going back and forth to work. I have accounted for incidentals such as, you know, birthday presents and clothing and personal items that they might need. So those are, you want to just base your decision and your rating criteria on this with all of those things in mind. And next slide, please. So the next slide is collateral. When you're assessing for a secured product, such as a car loan or a home loan, borrowers are required to pledge certain assets under each name as collateral. So if you're applying for a car loan, that car is going to be the collateral. If you're applying for a home loan, that home is going to be the collateral. They may also include fixed assets such as titles to a parcel of land, or financial assets such as security bonds. When the applicant is requesting to borrow a significant amount of money, the loan officer needs to know protected if the borrower doesn't repay the loan. So that's where collateral comes in. The collateral or assets can be sold and used as backup source of repayment. And that offers the lending institution that's making the loan some protection for the other loan. So basically, if a loan is backed up by collateral, it's a little less risky than a loan that isn't backed up by collateral. In the case of a mortgage loan, the collateral is the home itself. If the borrower doesn't make the mortgage payments, the lender can foreclose the home, sell it off, and recoup some of their lost funds. Next slide, please. So these are just some common types of collateral that we often see. Real estate, like we've talked about, automobiles, equipment like tractors and heavy equipment for like excavators and different things like that, perhaps recreational vehicles like RVs and boats, personal property and other valuables. And next slide, please. So I just want to pose this question to the group, much like we talked about non-traditional credit references. I want to kind of pose the question to the group about non-traditional examples of collateral. So maybe this is collateral that you've taken yourself as a lending institution, or collateral that you've heard of. So if you just want to put that in the chat, or maybe even unmute yourself, that would be great.
Hi, my name is Monica Mandrelli-Chavelle, but we worked with a company and their collateral, she was a jewelry artist, so she had nothing else but her jewelry, so we allowed her to have her jewelry as collateral for this loan.
Yeah. You were a little quiet there. I don't know if everybody heard you.
Yeah, I could hear, and basically she was saying jewelry, that they allow jewelry to be used as a non-traditional example of collateral. So that's really good. And yes, that is definitely an example of non-traditional examples of credit. We do have one in the chat, which is tribal gaming dividends, which is basically like a per cap kind of program. Are there any other examples that y'all have of some non-traditional collateral? Okay, I don't see any more coming up in the chat, so I'm just going to give you some ideas. So some other ideas would be intangible assets, such as patents or trademarks that the loan client might have. Also contracts. So in the event, it could be like for a manufacturer or even a contractor, a construction contractor, if they have signed contracts that they can show as revenue coming in, you may also use those as collateral. Stocks and CDs, and also life insurance policies. So there's quite a few different things that you can use if somebody doesn't have a traditional item to put up for collateral. And next slide, please. So anytime you take collateral, there is a process to go through for evaluating the collateral. It's basically a three-step process. You have to identify the available collateral, you have to determine its market value, and then you have to discount the market value. So the value of collateral is evaluated by deducting the value of current loans secured through the same asset. So the remaining equity indicates the true value of the collateral for the borrower. And the evaluation of the liquidity of collateral is also dependent on the type of asset, its location, and its potential marketability. So is it sellable in the event that you as a lender have to use that collateral to recoup the money that you lent out in the event of non-payment? Next slide, please. So this is kind of just an overview of collateral considerations. So again, valuing that collateral is really important. And you also want to make sure that you're using current industry standards for whatever that item is, and then local information, because certain items, certain assets are worth more in certain areas of the country than other areas. So you're going to always want to make sure that whenever you're valuing that and you're getting that market value, that it's local information and not a national number. Also, you want to make sure you're discounting that collateral for depreciation and devaluation over the course of the loan. And you also want to make sure that if somebody is using collateral to secure a loan, that you're matching that loan term with the life of the collateral that they're putting up. Generally, the loan amount should not exceed the discounted collateral value. So that's why we use a calculation called loan to value. And basically, you're taking the amount of the loan request and you're going to divide it by the amount of the collateral or the value of the collateral. And again, I want to emphasize the discounted value of the collateral. And next slide, please. So this is just a slide that kind of gives some examples of how you can mitigate the risk of the 5 C's. So even though you might have went through the 5 C's with your loan client or your loan applicant, and they all looked pretty good, and you felt really good about all of them with that particular loan client, there is still risk that comes with those. So it could be risk that comes that may not be present today at the time of the loan application, but it's risk that comes into play as the loan matures and as throughout the term of the loan. So the first thing you can do is you can lower the amount of the loan request. So if someone requests $5,000, you're not quite 100% comfortable with that, you can recommend $4,500 or less. You can, in the case of like a consolidation loan, you can make payments directly to vendors instead of to the loan applicant. You can require insurance. You can hold titles or certain items of collateral on your premise. You can file liens in a timely manner, verify the collateral value with a professional. You can build an ongoing relationship with this client through frequent communication, and you can also do frequent loan monitoring. So one of the questions that came up in the chat was, how do you secure a non-traditional item of credit? And the way you secure that is that you hold it in a safety deposit box. And next slide, please. So we call the 5 C's plus 1, which is the other C, and that's the social benefit. So one of the things you want to look at here is, does this particular loan that you're looking at or reviewing, does it help your organization meet its mission? If it does, you might want to give it further consideration, even if you're not feeling really great about it. Also, you want to ask yourself, what does this loan do for the individual, the community, the local economy? So if you can prove positive things by those 3 questions, again, it gives you more flexibility in going back and reviewing everything you learned and looking at that loan a little closer. You also want to see if there's any measurable social impact. And then, is there enough social benefit to outweigh any credit weaknesses? So those are additional questions you can ask yourself through the due diligence process and through reviewing and evaluating the 5 C's on all of your loan applicants. And next slide, please. So I am going to open it up to see if there's any additional questions right now.
Flo, I'm not sure if Charmaine was answered, but did you answer what if a tribal member has a lot of overdrafts? Can that hurt being qualified for a loan?
Yes, I did answer that already.
Okay. Okay, thank
Thank
you.
you.
And then somebody mentioned tribal gaming dividends for collateral, I believe. And then
Yep.
Sharon inquired, how do you secure it? And I think she was maybe referencing the jewelry.
Yes, and I did address both of those already as well. Thank you, Crystal.
Awesome.
Okay, if we don't have any questions, we're going to move on to the next slide, please. And this is a fun little activity that we have for you on the 5 C's of credit, and we're going to let Michaela lead this.
Can you see my screen, everybody?
Yes.
Hey, Alex, can you post the link in the chat? I did not hit enter, so everybody can access it. I guess I could just, oh, here we go. I didn't realize I could do that. There we go. Thank you, Alex. Once everybody is on there, I'll kind of explain how it works.
We have to create an account, correct?
I don't believe so. I think you should be able to just follow that link and it should take you to the mural.
So when I click on it, it says to put your email and then it makes you sign in or join.
Is everyone else having that same issue?
You should just have to put your email in and click join mural, and then it should join. It shouldn't be asking for an account, but you do have to enter the email.
So the gray boxes are locked and the little circles all the way to the left are movable. And there's a bunch of different circles. So for example, you would just take so I have character, capital, collateral, capacity, and conditions. And you would just take your, you would just take one of the circles and put it, you know, where you think it belongs. Does anybody have any questions about this?
Looks like everyone says that it's requesting an account.
Yeah, once you once you put your email address in, it's going to create like a version so that you can get in. You'll have to do that. It's basic questions, your first, last name, and email. I'll go ahead and repost the link, Annie, so that you have it, because I know things can get lost in the chat very quickly.
I did just post that again.
Perfect. Quick fingers.
You can make the screen bigger if you can't read. There's a little plus button down on the bottom right if you want to zoom it in there. Like so, but then now you can't see it all. So back to that. Oh, darn it, I should have changed them all different colors.
Henrietta, were you able to get in there? Sometimes
No,
with like
I just get a
pop-up-
blank screen.
You just get a blank screen. It
Yeah.
could be that you might have like pop-up blockers or something along those lines. So what I would do is just
Okay.
copy the link and paste it into a web browser and then hit enter from there.
Okay.
See if that works. For everyone that's having a really hard time getting in, just hang on tight. I'm sure we'll be finished with the exercise momentarily, but we appreciate your attempt to get in there.
Yes, and Alex did just put in a visitor link that may eliminate the need for setting up anything and maybe some pop-ups.
Awesome. Great. It worked.
And so as you can see by the answers to this, there's really not a right or wrong answer. In some instances there is, like for example, credit history. We know that credit history belongs to the character, one of the 5C of the character. But some of the other ones, it can have more than one. So some of the other items that, like skin in the game, that can be, more than one of the 5Cs. The trustworthiness of a potential borrower, that's character as well. So there's some of these that are more flexible that you're going to be looking at more than one of the 5Cs for to determine this thing, but then there's some that are more specific to like the 5Cs, like credit history and the trustworthiness, that type of thing. So the whole idea was just to get you all thinking about these things so that when you go back to your own financial institutions or your own workplaces and are looking at these things, that it's kind of going to give you some food for thought. I'm still seeing quite a bit of activity here, so I'm going to leave this open a little bit more. And Michaela, can you make sure that we save this sheet so that we can send this out with the other documentation? Okay, so we are going to go ahead and end this now. Thank you so much for all of those who participated, and we apologize for the issues at the beginning. Can we go ahead and share the PowerPoint again, Louis? Thank you so much. And can you go on to the next slide? So we were planning a 5-minute break here, but we are running a little bit behind. So we are going to go ahead and keep working. I hope that that's okay with you all. Can you go to the next slide? So we're going to kind of, instead of taking a break here, and for those of you who want to take a break, you can go ahead and do that. But we're going to play a little game with everybody right now, just to kind of, so we can kind of relax and then go on to the next session, because I know some of this has been some heavy content. So we want to kind of give everyone just a little breather before we go on to the underwriting process. So Michaela?
Yes, so once I show you actually, can you stop sharing the presentation so we can all see everybody's faces? Thank you. Oh, okay. So I'm going to, I don't know if you have ever played this before. It works great in person, but the whole point is to have one winner. So I'm just gonna show you how it works really quick, and then the animal stances that we make to represent that animal. So this is going to bring you back into living room, and just let everybody have fun. You can stand up if you want, or we can sit down. I'm gonna sit down. So first we have Tatanka, which is buffalo. So this is the buffalo. All right, this is what you do. And then we have Chinook, which is salmon, my little salmon. And then we have Magizi, which is eagle. And then we have Maingan, which is wolf. Okay, so I'm going to do my animal, and whoever is doing the same animal as me is out. And then I'm going to pass it on to someone else. And then that person goes, and then whoever is doing the same animal as that person is out. So does anyone have any questions about it? No? All right. So I'm going to go first, and I'm going to count to 3. And at 3, we all do it, okay? Okay, 1, 2, 3. Okay, who is doing the fish? Everybody's out. You guys can turn off your screen if that's easier, so we know who's all out. Okay, I'm gonna call on Alex next.
Okay.
Oh yeah, you can go. You can count to 3. Everybody count to 3 if it's your turn.
Okay. 1, 2, 3. Okay, so whoever did eagle is out.
Aw.
A lot of people.
Okay, then I'll pass it to Ashley. Okay, so 1, 2, 3. Okay, whoever did buffalo is out. Okay, so Ashley, you can pass it on to someone else. I think,
You can put it in the chat if
We couldn't hear you, Ashley.
Oh.
Raven. So Raven's up.
okay, so 1, 2, 3.
Oh, a bunch of people got eliminated.
you can
We
select.
can't hear you, Raven. So can you choose someone in chat?
Shelly, Sayri, Alex, Doris, and Dana. All right, Shelly.
What's up? 1, 2, 3. Buffalo. Guess what? We have a winner, and that's Raven. Good job, Raven.
Well, I hope you guys all enjoyed that fun little game. Up next, if you could share the presentation again, I believe it's Jamie.
Hi, everyone, and now we're going to talk about the underwriting process. So let me just get ready here. Well, now you can take what you've learned from Flo's introduction and understanding the 5 C's and Alex's loan officer process and apply that knowledge to specifically analyzing your borrower or your applicant. Through a quantitative assessment, you will be using a data-driven, so next slide, please. You'll be using a data-driven process to understand the financial strength of your applicant. This is where you will be taking all of the financial information provided by your borrower and really get into the inner financial performance of the applicant. Through the qualitative assessment, you'll focus on the probability of any potential internal or external threat or the possibility of, if uncertain events occurred, how could that potentially impact your borrower? Next slide, please. As Alex discussed, it is best to have a consistent process when underwriting. You need to know your loan policies and procedures. Your organization's loan policies and procedures serves as your approved guide to operate your loan program. Loan policies and procedures are often referred to as living documents since they are updated on a regular basis to be current with your organization, the needs of your market, and your lending environment. So you'll be reviewing your applicant for the basic loan eligibility requirements, which Alex went over. So I may reiterate some of her information, but you'll just need to make sure that your organization, you'll be utilizing your organization's predetermined eligibility parameters for both your applicant and the types of loans that your organization offers in your loan policy. If your applicant does not meet the eligibility requirements, let them know exactly what that is and provide them with guidance on what needs to happen for them to become an eligible borrower. If they are seeking a loan type that you do not offer, consult your community's lending partners that serve the same market, and if possible, you can refer them to other preferred lenders that may be able to serve their needs. Do provide caution against using a predatory lender type. If you do determine that you have an eligible borrower for a loan type that you do offer, like Alex said, set the expectations of the process and the expected timeline for review and decisioning. Be realistic. Do not overpromise and underdeliver, but underpromise and overdeliver. You do represent your organization as a professional, and in your role as a lender, you are beginning, hopefully, the development of a long-term relationship with your client. So you will want to make sure to set the stage for your client's expectations. So you will definitely need to obtain a complete loan package, because to appropriately underwrite a loan in a timely manner, you will need all of the required documents upfront from your borrower. It is really difficult to keep the loan process moving forward when you must go back to your applicant on multiple occasions to request information. Use a loan checklist, as Alex referred to. This is a learned process, and once you get it down, you will find improvement in time management. Next, you'll be completing your financial analysis review, which is really considered the core of underwriting. When lending money, the intent is that you'll be repaid, and then you'll turn those dollars again and re-lend, all with the intent to support your client's financial well-being and your community's economy. That makes knowing your client critical to being a good lender. You are assessing through both qualitative and quantitative information your applicant's borrowing capacity and their ability to repay. Each type of lending will have a credit review process specific to that type of lending, whether it's a consumer, a business, an agricultural producer, a nonprofit organization, a tribal entity, whomever your borrower is. Each type of borrower will have a specific credit review process. Loan policy and procedure will provide guidance for each type of borrower you work with and each type of loan you offer. You may be using a software application to input borrower information that will provide you with the financial information, including financial trends and financial ratios, or you may have an internally developed financial analysis process to take information your borrower has provided, and then you will review to make a credit decision. The spectrum of lending can go from basic to very complex, depending on the type of borrower you are working with and the type of loan product you're working with. So through the entire process, you will be charged with identifying credit risks. As you are working with your applicant and through your credit review, are there any red flags that pop up? Alex went through some of those examples, such as a low credit score or a lot of personal debt, or for business, it could be business losses or high amount of business debt, resulting in a high debt service coverage ratio. If there are things that are popping out to you that could potentially be red flags, keep notes on them so that as you identify those red flags, perhaps you may be able to identify potential credit mitigants to those risks as you move through the underwriting process. Does your applicant qualify? If you identify an issue that makes the applicant ineligible, such as a credit score that is under your threshold for which is under your acceptable threshold, you will want to review the credit report to understand what is driving that score down. If the applicant is not loan ready, you may have to go back to the applicant to understand what caused the issues that you were able to identify in the credit report, and to advise that those issues would need to be addressed to qualify for a loan with your organization. Leave your applicant with dignity. Getting declined for a loan can be a very difficult situation for an applicant. So if you are able to determine they do not qualify, present it as not now and this is why. Provide clear reasoning for any decline and advise the applicant what they need to do to become eligible. Understand your credit risk mitigants. There is credit risk with every loan. The only exception is 100% cash secured loan. As you identify red flags in your credit review process and you're keeping track of them, are you able to find some financial strengths that your applicant has that could possibly mitigate those credit weaknesses? There may be other options that you could offer to help mitigate risk, which could be such things as requiring a co-borrower. If it's a business, perhaps looking at another guarantor, or you could request collateral if you were looking at an unsecured loan, or if you are looking at a secured loan, you could request additional collateral. Determine your applicant's loan terms. Based off your credit review and financial analysis, the strength of the applicant and the loan purpose, select the most appropriate loan terms as outlined in loan policy. And then you will be making a recommendation to your approvers. Lending organizations have a loan approval process outlined in loan policy. It is recommended that every loan be reviewed and discussed internally with the appropriate lending staff within your organization so that all approvers have a clear understanding of the applicant and all of the associated credit risks and mitigants. Once you've completed your due diligence, financial analysis, and credit review, all information utilized in the credit process must be documented in a credit write-up we refer to as the credit memo, which will be submitted to your approver and to obtain the final loan decision. Next slide. Your loan purpose, understanding your loan purpose is critical. You must understand why your applicant needs financing. Sometimes it's not clear. A person may come in and they think they need to borrow money, but they're not able to articulate exactly what they need funding for. So what you'll do in that initial interview is just ask questions until you have a very defined understanding of what the loan purpose is. This will allow you to appropriately underwrite the loan request and also put the applicant in the correct type of loan product. In your financial analysis, depending on the type of lending that you do, you must know what you're looking for in reviewing financial trends, and you need to know and understand the key financial performance ratios, and you also need to understand your applicant's cash flow. In the collateral analysis, Flo went through this really in detail in her presentation on the 5 C's, and so just know that this is an important part of your credit underwriting and that you'll need to speak to it in your credit memo and provide your approvers with the specific information on the collateral that is posed to secure your loan. Does your borrower have equity? Most lenders do not provide 100% financing, but look to their borrower to provide, it's called borrower equity or down payment or a cash injection. As was referred to earlier, having some skin in the game. If a borrower has a personal cash investment, they are more likely to repay. Next, we'll look at other credit analysis factors for consumer and business lending. Next slide. In consumer lending, your financial analysis will include, but is not limited to, the calculation of the debt to income ratio, the applicant's current credit score and credit history, a review of income sources and reliability of those sources, and the collateral analysis if applicable. The most common documents obtained with a loan application are, of course, the current credit report, a current personal financial statement, which will show all of your applicants' assets, liabilities, and provide their net worth, current pay stubs, the most recent Form W-2, which is a verification of their pay. And you may or may not require this. You may just require pay stubs. If an individual is self-employed, you may need to request their individual tax returns to be able to verify their income. And they may work as a contracted employee for some type of an organization, and that can be reviewed through the IRS Form 1099. And then you'll collect collateral documents such as titles, information on your collateral, and perhaps the collateral valuation. You may need to request bank statements if you need to verify the borrower's down payment source. Next slide. Debt to income is really the most common ratio to determine personal cash flow. It compares how much an individual owes each month to how much they earn in gross monthly income. Specifically, it is the percentage of your gross monthly income that goes towards payments for rent, mortgage, credit cards, student loans, car payments, and any other of those types of debt. Next slide. This is an example of a debt to income ratio calculation. And in this example, the borrower is utilizing 38.57% of their income to make their housing and debt payments. It is expected that an adequate amount of income be available to an individual to pay all of their other household expenses, which could include childcare, gas, insurance, phone, food, internet, cable, utilities, etc. As this example demonstrates, with an additional payment of $150 per month, which could be the payment of a loan that they are applying for, this borrower's debt to income ratio now increases to over 40%. Is this acceptable? Check your loan policies and procedures. Your lending policy and procedures will provide guidelines for acceptable debt to income ratios for your organization. You should always calculate the debt to service ratio with the new debt. You can use the debt to income ratio as a coaching tool with your borrower. They may need to pay off debt before they will be loan ready. They may have some accounts out there that you recommend they close, or they may be expecting a change that could possibly affect their monthly gross income in the near future. As for loan payments, it's good to get the maturity date of those loan payments. So for example, if they have a car payment and that car payment is going to be paid off in 3 months, you may be able to remove that loan payment from your calculation since it will be paid off in a short term, if that is acceptable to your organization. Next slide. Some common business lending definitions of that are used to assess the financial condition of a business and business underwriting are leverage, which is the proportion of debt relative to equity; liquidity, which is the ability to cover current liabilities with current assets; and profitability, which is the degree to which a business yields a financial gain. The debt service coverage ratio is the measurement to measure the cash flow of a business. So you measure their funds flow, and then you look at all of their debt obligations, and you determine if the funds flow will cover all of that debt, including an additional debt payment. Next slide, please. I'm not going to go into a lot of detail on business financial ratios because they are and can be very complex, and really what I recommend is that as you continue your education as a loan officer, you seek out additional trainings such as analyzing financial statements, or training that might be specific to business credit underwriting. But the debt service coverage ratio is the most common, well, it is the ratio used to determine a business's borrowing capacity. So the basic calculation of the debt service coverage ratio is earnings, also known as net income, before interest, tax, depreciation, and amortization, which is also often referred to as EBITDA. And that is divided by the interest and principal debt payments of the business. And typically, this debt service coverage is measured on an annual basis. You may measure it more often depending on your loan monitoring or what your organization requires. But in order to calculate this ratio, you will need to have the business tax returns, financial statements, and debt schedule. This is just the basic calculation. There actually could be other considerations that you would need to review. And as you develop your underwriting skills and become more knowledgeable about other considerations when looking at the debt service coverage ratio. Next slide. So for business lending, for existing businesses, that's what you'll be reviewing is leverage, liquidity, profitability, the debt service coverage. You'll be looking at the financial strength of the guarantors, and you'll be analyzing your collateral. The most common documents are Dun & Bradstreet report. This may not apply to all businesses, but to some. You will be obtaining tax returns, both the business tax returns and the individual tax returns. If the individual is a sole proprietor, their business tax return you'll find in the Schedule C inside of their individual tax return. But you'll also obtain business financial statements for year-end financial statements, which would include the balance sheet, the income statement, the statement of cash flows. You'll also obtain a personal financial statement for all of your guarantors. You'll obtain a debt schedule. You need to have that to be able to calculate the debt service coverage. And it needs to be very specific so you know a lot about the debt that the business is holding, who it's to, the maturity, the original loan amount, the payments, when it matures, what the interest rate is. This will help you in evaluating your business client. Next slide. Startups are a little bit different, and business acquisitions. So in addition to the information that we just talked about, you'll also obtain a business plan because for a startup, you have no historical financial information to measure. So you're going to be looking at future. So you'll be obtaining a business plan. You'll be obtaining future business projections. You'll be looking at sources and uses, which is if you borrow this money, what specifically will it be used for in the startup or business acquisition? Again, you'll be looking at your guarantors, but in addition to their financial strength, you will be looking at their experience. Do they have the experience, industry experience, management experience to operate this startup they're proposing or in buying this business? That's something you will be evaluating. And the documents that you'll be collecting are very similar. The only additions will be the things mentioned, such as the business plan, projections, a sources and uses statement. Next slide. This was just a little exercise that was added in to our training, which is for you to calculate Rita's debt to income ratio. So Rita earns $2,000 a month. That's her gross monthly income. Her payments are, she has a $300 monthly payment for a home loan. And she does have a credit card, but it does not have a balance. She pays it in full every month, and she's been able to demonstrate that. She pays $100 a month for her car payment, and she pays $75 a month to repay her student loan. So what is Rita's debt to income ratio? And you can put it in the chat. Aha, yes. We got some fast calculators out there. So both Brenda and Ashley, yes, rounded up, it is 24%. Ooh, good job. There was one question in regards to loan officer training for business, commercial, or home loan underwriting. I think there's a lot of sources of training. I don't know if anybody else on the team would be able to answer that question more specifically. And so maybe we'll get to that at the end of my presentation. Okay, now I'm going to move into understanding risk. Once you have completed your quantitative applicants assessment, what other credit risks are there? Credit risk is the possibility of a loss resulting from a borrower's failure to repay a loan or meet their contractual obligations. Although it is impossible to know exactly who will default on a loan, properly assessing and managing credit risk can lessen that possibility of a loss. Next slide. Next slide, please. Thanks, I got ahead of myself, sorry about that. We have reviewed examples of quantitative measures to identify risk. What are qualitative measures? One of the best practices of managing risk is to know your borrower. When you begin working with your clients, you will develop a personal relationship, and in some cases, these relationships will become long-term. So you'll become intimately involved and knowledgeable about your client's personal finances, about your business owner's business operations, about your agricultural producer's farm operations, and your nonprofit's organization's mission and strategic plan. You will be looked upon to provide financial advice and guidance, which you will be able to provide in some cases, but in other cases, you may need to refer your client back to their CPA, attorney, investment advisor, or other financial partner, but you really do become part of your borrower's financial team. As a loan officer, it is your responsibility to ask the right questions around a qualitative assessment and be able to classify or rate at which level your borrower could potentially be impacted. And this is part of your due diligence. So one thing you'll be looking at is what is the quality of their financial statements? Are they done by a CPA? Are they audited? Are they reviewed? Are they compiled? Or are they prepared internally by a department within the organization, or perhaps they have another organization that is doing their financials for them, or perhaps they use a bookkeeper to keep their financial statements for them. What is happening in the applicant's industry? Are there current trends, challenges, changes? How is the industry evolving? And these really apply to a business applicant. Understand the business competition. Is the business, do they have a regional, a national, a local, or an online presence? What are their competitive advantages and disadvantages? Understand the business owners and key management's business expertise. What is their management experience, and how long have they worked in the industry, or what experience do they have in the industry? Does the business applicant have a well-defined succession plan? Which means if something were to happen to the owner, how would this business continue to operate? What expertise exists, additional expertise? It could be key management, it could be another family member that's part of this business, but you will want to know what that is. What is the current business environment? Are there economic, political, geographical, or regulatory factors that could affect this business operation? And are there any legal issues that a business or business owner may be facing? That's why you review public records to look for such things as existing lawsuits, prior bankruptcies, and possibly criminal histories. Each category should be assessed and rated as part of your business underwriting. Next slide. What other sources are there to consider? You'll want to develop an underwriting process that captures the review of all credit risk. Flo covered most of this in her 5 C's of credit presentation. One thing I just wanted to add was it's important for a lender to look at concentrations. So understand if your loan policy provides guidance on concentration, and this could include borrower concentration, concentration in business sectors, and concentration in loan products. And this is your loan portfolio, the concentration of your loan portfolio. A diversified loan portfolio is a risk mitigant to a lender. Next slide, please. Key takeaways with credit risk. Lenders avoid acceptable risk through eligibility requirements and underwriting standards. Lenders mitigate risk through structuring and technical assistance. Lenders accept certain risks through analysis and planning. And the lender's most powerful risk mitigant is relationship. How much risk is your organization willing to accept? Next slide. The 4 steps of credit risk management after you make the loan are setting the expectation with your borrower on how your relationship will move forward post-loan closing. Make sure that you have a good portfolio management system within your organization, which would include consistent loan monitoring. And you will always want to stay engaged with your loan client. If you just had a way to touch base with them every so often, and that could be through some of the other services that your organization provides, or if you just make sure you set some type of targets in the future of when you want to reach out to your borrower just to check in to see how things are going. Because it could be that you're developing a relationship, so you will have future opportunities, and the only way you're going to be able to capture those opportunities is if you know what's happening with your borrower. So next, we're going to turn our presentation over to Flo, who's going to talk about how to risk rate loans.
Thank you, Janie. And I'm not going to spend a whole lot of time on this section because this is like a more advanced training, and we are expanding on this training on May 13th with our loan policy training. So if you want more in depth on risk rating loans, we are going to cover it a lot better in that section. But we did want to like introduce it to you now, just so you would have an idea that this is part of underwriting and due diligence. And then I see that Lola has a question. Lola, did you want to go ahead and ask your question?
Oh, no, I just wanted that information on your other training on the 13th.
Oh yeah, I think Crystal Cedino can put that in the chat.
Thanks, that was it. Thank you.
Thank you. Can we go to the next slide, please? So there's just so risk rating is just a systematic, approach to rating your loans and how you feel about them as far as what type of risk it brings to the organization. And it's different for everybody. And it really, a lot of it has to do with your credit culture at your organization and different things like that. The credit risk rating system involves categorizing the risk associated with the individual loans using like a thorough credit analysis that you do. And in order to do that, you consider like market conditions, industry data, and other factors that's necessary to assess like what the borrower's credit quality is. And then that actually determines the organization's risk. Can you go to the next slide, please? So why do we risk rate? The credit risk rating systems rank individual loans into a series of categories based on the type of risk or the severity of the risk associated with that loan. And then the lender assigns the ratings after it evaluates both quantitative and qualitative factors with the loan or the applicant. And then from there, the lender assigns the loan a risk rating. And that's always done before you close. It's done basically when you're preparing the credit memo. Next slide, please. So when you're determining your risk factors, there's just a couple of things you want to be aware of. So you want to make sure that whatever factors you choose to risk rate a loan, that it actually has some merit to it. So you want to use factors that have accompanied past delinquencies or defaults or foreclosures in the past. So because that really is a measure of how much risk that you're accepting and gonna come under potential risk for with a particular loan based on like your historical borrowing history. You also want to confirm the correlations between the factors that you select and the actual history. So kind of what I just said, you want to make sure that there's some historical numbers there that you're basing your risk factors off of. You don't want to choose multiple risk factors that address the same risk because then you're not really getting a quality risk rating. You also want to consider costs such as time and money of evaluating those factors during the underwriting and the ongoing monitoring process. If you're choosing a risk factor that's going to take a lot of time, you might want to look at a different one. Also, you don't want to go with too many factors because they can turn out to be burdensome and it wouldn't give you full results. And next slide, please. These are just some sample risk factors that I put on a table. Credit score, auto payments, collateral, cash flow, equity, business, character, training hours, and then I kind of divided them up between the three major types of lending, housing and consumer lending, and what some of the things that you would look at for each one of those in relation to the risk factor. And next slide, please. This is just a sample risk rating factor rubric. So I just took, 4 just for the sake of this table. I weighed them all at certain percentages and then gave the maximum score that they could get. And so that kind of gives us a guideline to go forward on. And next slide, please. And then this is the sample loan rating rubric. So as you can see, anyone who scored 90 to 100 points total on the prior rubric would be given a loan rating of 1. And I would be undoubted means I don't have any doubts that this person will repay the loan. And then for the last one, 45 to 59, they would receive a loan rating of 5. And I would rate this as unsatisfactory risk. This is when I would go to that extra C and look at the community benefit and the social benefit to see if I really wanted to make that loan or not. And the next slide, please. Any questions on this part so far? You can either go ahead.
I tossed the link into the chat box just so everyone knows for loan policy development.
Thank you, Crystal.
You're welcome.
Lindsay's question is, what is the average time frame you have all seen a loan been approved from inquiry to loan closing?
Yeah, that really just depends on the institution and what your internal processes and procedures are. You know, for OWISTA, it's a significant amount of time. And that's because we are underwriting commercially. So we don't do direct lending to consumers. We're doing lending to other CDFIs. So we're actually doing kind of business underwriting. And our credit memo is quite lengthy because we're generally dealing with you know, several tens of thousands of dollars, hundreds of thousands of dollars, and even into the millions in some of our loan requests. So ours are quite lengthy and it takes a lot of time, but that really depends on your internal lending process and procedure. I would say you probably, if it's just a regular consumer loan or a business loan, I would think you would want to do that within a month, just depending on how well documented that particular loan applicant is, and if you are actually able to do that. Can we go to the next slide, please? And then I think the next slide, no, back, I'm sorry. Yeah, so we are going to go into breakout rooms now. We're going to go into 4 different breakout rooms, and each one of us from OWISTA is going to be in the room with you. And we have case studies that we're going to work on. And those case studies, we're going to do some work in the breakout room to come up with an answer. And then we're going to pick someone in the breakout room to present back to the group as a whole. I'm going to give everybody about 7 minutes room. So we're going to come back about 1:07, and then we'll give about 8 minutes to report. So we'll be done with this entire activity, hopefully by about 1:15. So Michaela or Crystal, whoever is doing it, can we go ahead and get everybody out into the 4 breakout rooms?
Yes, Alex is on it.
Thank you.
Louis, are you still there?
Yes.
Okay, I see your mouse moving. Shelly, Olivia, Lehman, are any of you there? The 915 number, if you can open up your mic and let me know who you are so that we can make sure we count you on registration, I greatly appreciate that. (915), it's the only phone number in the room. (915), may I have a name? You can go ahead and unmute yourself.
Okay, group 3 is back with the food truck. I don't know if Alex and Jamie and Flo are back.
Nope, doesn't look like it.
All right. Yeah, it did take a little bit longer to discuss, but that's okay.
Oh, good. 915, can you please let me know who you are?
Hello?
Hi, there you are.
Hi. I'm sorry. I have to listen to my phone because my computer has no audio and I couldn't figure out how to unmute myself.
No worries. What is your name?
I'm Melissa Sinclair.
Okay, thank you, Melissa.
Thank you.
No problem. Awesome. Figured that one out. Hi, everyone who's back. Can't hear you, Flo. You're muted.
Is everybody back?
I see. No, not everyone's back.
Can we manually end the breakout sessions?
Yeah, they're ending in 6 seconds.
Okay, thank you.
You're welcome.
Group 3 with the food truck, we did not decide who was going to speak on behalf of the group. So if you guys wanted to put it in the chat or offer yourself up.
Okay, so we're gonna welcome back everybody. I hope you had some good dialogue in your breakout rooms, and we're gonna start with group number 4. Who is the reporter for group number 4?
We also didn't decide on someone, so if someone wants to take over or a couple people could go ahead and share.
I guess I will for our group. We had really good ideas. We didn't have enough information about his terms of loan process. We evaluated him taking out his loans to in his payments for I think for his monthly bills. And so we thought that was, 6 times, and then he was late on 2 of them. We also observed him about being a single father too, and the consequences of him taking out such a big loan on a $10,000 truck. Was it a truck, or was it just the truck and like maintenance to it? And then like did he know enough information about it? Like, we didn't have enough background to know that he was, he just thought it was a great idea because it was good money. So we didn't have enough background on how much he knew and like had a business plan maybe. And then I was thinking towards the end there about, maybe he could look at getting another job and saving a percentage of that, or looking towards like tax money, instead of taking out $10,000, maybe he could save up to 5, or, with annual tax return time since he had 2 kids. And then we were concerned about him taking out such a big loan too on behalf of his children. What would happen to his personal life, including if something happened to him. We had really good ideas. I mean, there was like probably not a part of this scenario that we didn't come up with. I mean, overall, I think we had questions about more information about the loan he wanted, how long it was, and if, so we couldn't really come to like something that, of course we'd love to offer our people this kind of money and help them out and stuff, but in this setting, we would like him to be more secure, and him having 3 different jobs is also something not reliable for him to take out such a large loan. So yeah, there was great ideas in our group.
That's awesome. Thank you, Shasheen. So let's go ahead and move on to group number 3. Who was my volunteer for group number 3?
That was the food truck one. So whoever would like to go forward, I'll share my screen. I had Becky in with me, and
I was part of that group. I guess I'll jump in there. I think Becky was taking some good notes, but so we had Opal Johnson, who's 35, and single, who's been working as an assistant manager at a local grocery store, makes about 25,000 a year. Her ex-husband and her daughter live in a nearby town, and she doesn't have no savings. The amount that she reported was 400 for rent and has credit card debt. And her credit report revealed paying late on her credit card and collection accounts for charge off for cable. She wants to purchase a food truck for $15,000 to start her own business, noting that there are no other food trucks on the reservation. And this would be for a side hustle for additional income. And so we talked about the risks, and there were no savings, late payment on the credit card, and it's only paying the minimum, and those two collections. I would say, I mean, maybe it's limited credit history or just those two collection accounts. I would, and then the capacity would be no savings. Her capital, her debt to income ratio, just with the information provided, was 22%. There was questions, you know, as far as additional, her other costs, her fixed and flexible costs, and if she has any other assets. And then the other one, given that her 15-year-old, I'm a mom, so I know the costs of having kids, and especially a teenage daughter, if she owes any type of child support or support for her daughter. And then the collateral, we talked about as far as the food truck could be used as collateral, depending on your loan policy, if it's 100% collateral or beyond that, or if any other type of guarantees to back that up. The conditions is that there are no other food trucks on the reservation. And then I believe she did intend to continue her job as a cashier, assistant manager cashier, or at the grocery store, while operating this as a side hustle. So the group, we were all in favor as no, but I know what we like to say is not yet. But work with her to reduce her debt, the credit card debt, and build her credit. Develop a savings goal for, you know, to have, so that she has some skin in the game, and also a business plan, because the loan was request for a food truck, but it was brought up as far as like the cost of inventory. Was that it? Did I get it, guys?
Great. Thank you, Janelle. That was a good report out. How about group number 2, Jamie's group? Who's the reporter for that? And Jamie, can you share the case study? Great.
So it was a TP rental business, and they are requesting $2,400 from the CDFI to purchase 3 more TPs. And the person's current expenses, Gus, has $250 in rent and utility expenses, and $450 in revenue or income from SSI, and then $200 he spends on food stamps. And so as far as the 5 C's goes, the character, we said there's some spotty history with trust and follow through. He does take the business class twice, but is successful the second time around. He doesn't have a high school diploma and has some character that people see as a little bit of a jokester. And he does have a recent DUI on his record, so we would want to know more about that and maybe what conditions prompted that happening. So the capacity, he does have some capacity. He's had this business running for a while. He does have the word of mouth and more interest in the services being expanded. And the quality, so as far as the conditions go, we don't know much about what's happening in this community as far as demand for that product. But he has owned these two before, or for a while now. And we were curious about the quality of the TPs and sort of that network and where he's getting that supply, and if the technical assistance could support some better assurance around that. As far as collateral, he does have the existing TPs. He does own a truck, but he doesn't have a license at the time. So he's getting support from a friend, which we thought might have more information for us about references as far as character goes, because he's sort of relying a lot on his friend to support the business and transport the TPs. And then what we found for capital is a debt income ratio of 23%. So even after the loss in SSI from this revenue source and the expenses of upkeeping the business, he still has a decent sort of risk profile there. And as a group, we did not reach any formalized conclusion, but had some more areas where we thought we could learn more and that he might be a good loan option for us. So, thank you.
Okay, awesome. Thank you, Courtney. How about group number one? And I think Joyce is the reporter for this one, and I will go ahead and share my screen of the case study.
Okay, so we have Karen, who is a single mom. She's got good work history, and she has a side business. She has a savings account. She has a car loan and some student debt. She doesn't have, and a credit card with a balance, which she makes the minimum payments. She doesn't have any late payments on her accounts in over 3 years, and she wants to purchase a home. So we talked about her character. We thought it was strong. She doesn't have any late payments. Has a strong work history. Her current debt to income is 26.4, so that's good. She has capital to put towards it. She's got $5,000 in savings. The collateral would be the house. And we didn't really have any conditions. We just had a risk that she's a single mom, and so there's not another income to help in case something happens there. But the only thing we wanted to see is maybe what her credit score was. But other than that, we were recommending this loan to the committee.
Great. Thank you so much, Joyce. So those are really good report outs on this exercise. And this was really done so that you all could kind of, for those of you who are not currently underwriting, that you could kind of get a taste of what it was like to kind of review some basics of a loan application or a loan applicant, and kind of get a feel for like what to look for the 5 C's and what some of the things that came up. So were there any other questions or comments on this section? Okay, from here, we have another activity, and we're going to be playing a game. And it's basically going to be going over all of the things we talked about. And it's going to be kind of like a quick review of all the things we talked about in this section. Michaela, can you go ahead and share your screen of the game and get everybody started with that? And then, oh, go ahead. I just had one thing. And then Louis, if you could please, on your end, advance the slides to number 87. So when we're done with the game, that slide number 87 will be up. Go ahead, Michaela. Thank you.
Okay, so we're gonna stay in the same groups that you guys were assigned to for the Family Feud game. Okay, we're gonna go in group order. So group 1 will go first, and you can unmute yourself and talk amongst yourself and let me know what the answer is. All right, it's bear with me here, guys. Okay, ready? All right, welcome to Family Feud. I'm your host, Michaela. Let's start with our first question, group 1. What are the 5 major types? Oh, wait, yeah. What are the 5 major lending types of a CDFI? Group 1, you can unmute yourself and talk amongst yourself.
Business,
All right.
consumer,
Woo! 1 point.
housing,
You have to keep going.
credit
1, 2
builder,
more. Wrong. 2. Whoever was in group 2 can unmute yourself and finish the question.
Agriculture. Community development.
Awesome. All right, next question. So group 3, you're up. What are some of the responsibilities of a loan officer?
Due diligence.
Client intake. They also said due diligence.
Part with that. Okay, I'll just give it to you.
Underwriting.
Financial analysis and due diligence.
Communication.
I'll give you that, but that's not an answer on here. But yes, that is one.
Personal relationship.
What was that one?
Personal relationship.
I'll give you that too, but that is not on here. Group 3, you're still up.
Credit analysis. I just have financial analysis.
I'm sorry, Becky.
And the credit analysis, but that might be considered.
I'll give you review credit history. Group 3, you're still up.
Someone say underwriting.
Yeah.
I'll give you that.
Figuring out collateral.
I'll give you that too. Okay, one more.
Collect necessary documents.
Yes. Application and document collection. All right, group 4, you get to finish. I'll pull up the question. What are some responsibilities of a loan officer?
Okay, with customers to help them decide what loan. Communicate with the customers to decide what loan is good for them.
Give you loan negotiation.
Loan negotiation, yeah.
Capacity.
That's that. I'll give you that one. We got one more answer.
Ensure client understands everything about the loan.
Correct too.
Client intake, loan negotiation.
Review
We
the
haven't discussed.
payment schedule.
Yes, management.
I'm just gonna give it to you. Prepare credit memo. All right, that was good, guys. All right, next one. Group 4, you're up. Step for the initial client intake process. Group 4.
Their income.
Confirm income.
Identify goals.
Okay, okay, that one's a good one.
Sure.
Okay,
Identify goals.
I'm going to do that one.
Credit
Identify
report.
client needs and eligibility. Sorry, I keep interrupting. No, you can guess again.
Explain loan procedures.
Yes. Explain loan
Determine
products and what.
Fill out the application.
I heard determine client readiness.
Is that the debt to income ratio? Provide list
Alan.
of needed documents.
Yes. You guys are on
Okay,
a
there you go.
roll.
Verify
So what's the
collateral.
loan process?
Direct them to the loan application they need.
You guys are on a roll. We got 3 more.
What do you have to
Provide
have?
a checklist.
Lead with a commitment to follow up
Yes.
and direct them to the loan application needed.
Well, complete loan application. 1 more.
Set
I don't know
reasonable
if that's
expectations.
Reasonable experience. with the loan.
Yes. Set
Yay.
Hey.
Good job, team. We did it.
Okay, group 5 is up next.
We got all of ours.
There's no group 5. We're back to group 1.
Hey, never mind. 1. All right. List common financial documents for consumer lending.
Tax returns.
Here.
Pay stubs.
This question number
Credit
4.
score.
Okay, it's right here. Okay, I got it. Okay, sorry guys. Okay. Guess it again. Sorry, I didn't know where my answers were. Okay, I'm ready.
Tax returns.
Yes.
Check stubs.
Payroll.
Payroll check stub.
Bank statements.
Obligation documents.
Credit report.
Loan application.
That's not on here, but yes. 1 more, and then it's group number 2's turn. Guess again, guys.
W-2.
Woo! Awesome. Okay, I'm gonna let group number 2 go. Group number 2, you're up. You get to finish it.
Personal financial statement.
Woo! Yeah.
Collateral documents. And tax return. 1099 if you're self-employed.
Yes, go Sharon. All right. Okay, so that was group number 2 finished. So group number 3, you're up again. What are the 5 C's of credit plus 1? Group number 3.
Character. Character.
Collateral.
Capacity.
Conditions.
Community impact.
Yeah, whoop, whoop.
Capital.
Group number 3. Whoop, whoop. Next question. Group number 4, you're up. List non-traditional credit references.
Utility bills?
Housing entity or rental entity.
Utility?
Just 1 second. Sorry, guys. Okay. I think this is the correct one. I just wish I could see. Sorry. Okay. 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 Jesse, guys, I'm ready.
Utility bills? Stocks?
Contracts.
Rent.
Life insurance? Phone statements?
Bank account statements.
Okay.
Well, I guess
I apologize, everybody. Just give me 1 second. I need to.
Yeah, every time
I'm
you're
grateful.
answering.
Here, 1 second.
Jeez.
Okay, we're on this one. Okay, I'm on it. I'm on it. Okay. Yes, again, I'm very sorry.
Dividend statements?
Bank statements, yes.
Utilities?
Yes.
Cell phone statement? Contracts?
Life insurance.
Give you those ones, yep.
Landlord
credit card?
verifications.
Unsecured, what?
A secure credit card? Personal
Okay.
loan?
Is this my group? Is this group 4?
Yes, group 4.
Oh, okay. Sorry, guys.
Stocks? Recommendation for personal loan from a personal loan?
A friend.
Credit reference.
Life insurance?
Landlord verification.
Yes.
Childcare.
Childcare. Woo! Awesome, guys.
Yay.
That was great. That was group 4. Okay. Okay, next question. Group 1. What are some risk mitigations of the 5 C's? Group 2. No, yeah, group 1. Group 1. Sorry, group 1.
Lower the loan amount?
Having a relationship with the borrower. Trust.
That one's a good one. I'll give you that. Not on here though.
Require insurance?
Require, but I think I meant require.
Frequent loan monitoring?
One's not on here.
Require some sort of training.
Direct to vendor?
I guess I'll give you extend special terms.
Hold title?
Yes. One
Direct
more.
to vendor?
No. Nope. I'll give it to group 2 to finish it up if anybody in group 2 knows.
File the liens against your collateral.
Oh, yes, correct. Okay.
That's directly to vendors?
That one's not on here, but yes, that would have. Okay, we're gonna go to the next question. We'll let group number 2 take over. List some potential credit risk factors. Group number 2.
Credit history?
Job history.
Now those could both fall under credit score. I'll give you that.
High debt to income.
Score.
Capacity, high capacity. Not enough collateral.
That is one, collateral.
Okay,
They don't have the 5 Cs. They don't qualify for 5 Cs.
Yeah, or undefined goals.
They have no investment.
Yes,
Not, no
Is it
savings.
reputation? Character.
Their conditions are questionable. Things going on.
The industry. Competition.
Here, let me pull up the question again, just so we know.
It's like, yeah, it's cash flow or like capital, but I suppose you already have equity on there, so it's not really, it's job, right, or something.
You guys you can guess one more time and then I'll pass it on to group 3.
Okay. Credit, did we say credit score? Their business history.
Woo! Awesome. All right, group 3, if you want to finish it up.
What was the question?
It was list some potential credit risk factors.
High debt to income.
Coverage is one.
Length of employment or employment history?
We'll do that as character. One more.
Fit.
Did you add conditions like COVID?
I'll give you that one. This, I don't know if anyone's gonna get it. I might just pop it up here. Ready? Payment shot.
Can
Question.
you explain what that means? What does that mean?
Yeah, we didn't discuss that. What's that?
They didn't agree to the terms of the loan. They had no idea what they'd be paying. When they found out at the very end, they were totally, like shocked. They didn't realize that.
If we're talking to our potential client from the get-go, that shouldn't happen, really.
Right. That's what they were saying. Keep them informed.
Well, I didn't know if I had to buy a house, I had to pay real estate taxes and insurance and home improvement and furniture and et cetera, et cetera.
Right. It also means this, and that is that a person who perhaps is living in low-income housing or tribal housing where their rent is based on their income, they might only be paying a couple $100 a month in rent. But then after they buy a house and get in their own house, all of a sudden they have an $800 house payment. So even though they knew their payment was going to be $800 to the whole loan process, it still is a shock the first time that $800 goes out because they're used to only paying like $200 to $300 to live. And that's just like one example. Also, if you are living like in an apartment or tribal housing, sometimes that the utilities tend to be less because you're in have smaller square footage and it doesn't cost as much to heat and different things like that. Where if you just purchased like a big 1,500 plus square foot house, all of a sudden your utility bill is probably going to triple or double at least from what it was, just because it takes more power to power the bigger. So people just, even though they knew and they knew that these expenses were coming, to actually have them come to fruition and have to write out that $800 a month check every month, it's still in some cases is kind of shocking to the loan client. So anyway, next question, please.
I believe it's we're gonna go with group number 3. What are the 4 steps of credit risk management? Group number 3.
Your slide didn't advance. There you go.
Okay, I'll show the question again. What are the 4 steps of credit risk management? Group number 3.
That'd be portfolio management.
Correct.
Communication.
One's a good one, but it's not part of the 4 steps. Well, I guess it is, but you know what I mean.
Loan loss reserve.
That's yeah, that one's good too. Not on here though.
Oh.
Sorry.
Setting borrower expectations.
Yes.
Loan monitoring.
Monitoring the loan, yeah.
Yes. One more.
Client outreach.
All right, we got one more question.
What was answer number 4 back there?
Yeah.
Client outreach.
It was client outreach. Yeah, sorry,
Okay.
I might be moving. Okay. This is the last one, group number 4. You're up. What were the 4 animals from the animal? Oh no, wait, did I do group number 4?
Yes.
Okay, so group number 1, what were the 4 animals from the animal game?
The eagle.
Chinook.
Tatanka.
Oh yeah, wolf.
Awesome, guys.
Very good. Thank you, Michaela. Hopefully you all enjoyed that. It was a kind of a quick little review and refresher for some of the major highlights of everything that we went over today. And I do want to just kind of reiterate that, you know, we kind of crammed a whole day's worth of training into 3 hours. So it was kind of a little bit difficult to go through some of the things in great detail. But we're going to be having more of these trainings and webinars where we do go into them, you know, in more depth and things like that. We're also launching a certification program for Native CDFI lending officers. So that will be launching like in the next 18 months.
Want to come over for the 2 o'clock training just for accountability? You can do that as well. At the 2 a.m. Oh no, I'm registered for that.
Whoops, somebody's talking and not muted. But anyway, so can we go? Can we have Jamie take over now and go back to the slide presentation? I think we are going to open it up for questions right now.
Yes, this is the last opportunity to ask a question. So if anybody has a question, you can just unmute yourself or you can put it in the chat.
Flo, did you line out the dates for the certification trainings?
We do not have the dates yet, but we are launching them, and we just watch our newsletters and our website, and we'll be giving everybody, you know, plenty of opportunity and warning on that.
Okay. And will it be by, as far as, you know, like by type? So, you know, consumer, small business, home, or community development?
Jamie, could you make a note of those things? So we're going to touch on each one of those at various times throughout the training, but there will not be a certification for, say, consumer lending. It will just be a loan officer certification. But in that training, we will talk about consumer, business, housing, agriculture, community development. We're not having, you know, like specific trainings on any one of those different types of loan products. But we will be talking about each one and have some activities as well as lecture on the underwriting for each one of those different loan types. And then somebody asked in the chat if you all were getting certificates for today's training, and I believe the Native Learning Center is sending out certificates for this.
I responded yes, but yeah, we'll email them to you, their certificates of attendance.
Are there any other questions? Well, next slide, please. Would anybody like to share a nugget or an aha moment that they experienced during today's presentation?
Call on someone. Miss Broody.
I knew it, since my name is high up alphabetically. I think I just got a lot more appreciation for my organization's process. I'm not a loan officer or an underwriter, but I am involved, you know, in the process, and I got a lot more appreciation for and just understanding of what they do and how they do their jobs.
Fuller.
For me, it just, as a loan clerk, I just need to be able to get a higher level overview of just like an eagle eye view, and that was what this class provided. So that was helpful.
Would anybody else like to speak out?
I enjoyed learning about the loan processes of other tribes. Our loan process is actually pretty simple. We do dividends and per capita as collateral for their loans. So it was just interesting hearing what all you guys put up for collateral as loans. I appreciated it today. Thank you so much.
Thank you. I
and
just
the
realized as
activities
far
were
as
fun as well.
It's fun. Yeah, just as far as like the depths of lending, you know, looking, I mean, even from like credit builder, you know, consumer type of lending, all the way up to larger business lending, there's different varying degrees in how you measure those. But I mean, there's still the basic components of it when you're looking at it, individuals, you know, the 5 C's or 6 C's, right? And so I'm still learning, even though I've been doing this for a few years. And then we also have new team members on the phone who are just now learning about CDFIs. And so they're on to understand as far as, you know, what a CDFI does and a loan fund. And so underwriting helps them understand those basics. So thank you.
Hi, ladies. This is Tawny speaking. I just having aha moments throughout. I love how you lay this out in a really good way. I like that intake aspect of it because that's what I used to do previously when I was a loan officer out here in Denver on the residential side. So just bringing it back to those basics, but always expanding. And you guys are just amazing. I love the games and activities, and you make this fun. So I appreciate that because sometimes finances aren't fun, but you made it fun. So I appreciate y'all killing it. Thank you.
Yes, non-traditional credit. Never knew how to verify this, so I'm glad we were able to elaborate on that for you. And I had a good time as well. I had fun.
All right, well, we would like to thank you all for joining us today for this Underwriting 101 training. We really appreciate your engagement and participation, and we look forward to seeing you again with our next scheduled class, which is May 13th, and it's loan policy development. Next slide, please. If you would like to contact us directly, we have Flo's email address on this slide. If you'd like to learn more about EWONAP, our website is also on this final slide. So thank you so much for joining us today and taking time, I'm sure, out of your very busy schedules.
Thanks, everyone.
Thank you.
Bye. Thanks, guys.
Thank you.
Bye.
Anticipate an email from Native Learning Center. It'll be a feedback form. It'll be sent to your email addresses that we have. So we appreciate you filling that out, letting us know how we can improve things. Thank you.
Okay.
Thank you. Bye.
Thank you. Don't forget to send us the videos.